In 2008, the collapse started in a housing subdivision in Nevada. It was local, it was visible, and it spread outward to the rest of the world. But the next crash, the crash of 2026, will work in the exact opposite direction. It will not start on Wall Street. It will not start in the U.S. housing market. It will start thousands of miles away, perhaps in a central bank meeting in Tokyo, perhaps on a trading desk in Shanghai, or perhaps in a conflict zone in the Middle East. You are watching the Federal Reserve. You are watching U.S. unemployment numbers, but you are watching the wrong thing. The U.S. economy is no longer an island. It is a node in a hyper-connected, hyper-fragile global network. We are living in a world where a decision made by a bureaucrat in Japan can double your mortgage payment in Arizona. We are living in a world where a war in Europe can erase the value of your 401k in Florida. This is the concept of the global trigger. In the next 25 minutes, I am going to take you on a tour of the global financial plumbing. I am going to show you the cracks that nobody is talking about on the evening news. I will explain why the U.S. housing market is actually being propped up by foreign debt and what happens when that prop gets kicked away. I will break down the $210 trillion derivatives bomb that binds global banks together in a suicide pact. And I will show you how to position yourself when the contagion hits our shores. This is not a story about American economics. This is a story about global survival. The Japanese fused the carry trade. If you want to see the future of the U.S. economy, you don't look at New York, you look at Tokyo. For the last 30 years, Japan has been the patient zero of global finance. They invented the policy of zero interest rates. And because of that, they created the biggest financial bubble in human history, known as the carry trade. Here is how it works and why it threatens your house. For decades, big hedge funds and global banks could borrow money in Japanese yen for free, 0% interest. They took those billions of yen, converted them into dollars, and bought U.S. assets. They bought U.S. tech stocks. They bought U.S. corporate bonds. And, most importantly, they bought U.S. mortgage-backed securities. Trillions of dollars of liquidity in the U.S. markets actually originated in Japan. It was free money. But in 2024 and 2025, something terrifying happened. Inflation finally hit Japan. The Bank of Japan was forced to raise interest rates for the first time in 17 years. This sounds small, going from 0% to 0.25% or 0.5%. But in the world of leverage, it is an earthquake. Suddenly, the free money isn't free anymore. The yen starts to strengthen against the dollar, and all those hedge funds, they are facing a massive margin call. To pay back their Japanese loans, they have to sell their U.S. assets. They have to sell NVIDIA. They have to sell U.S. Treasury bonds. They have to sell U.S. mortgage bonds. We saw a preview of this in August 2024. The Japanese market crashed 12% in one day, and U.S. mortgage rates spiked instantly. Why? Because when Japan sneezes, American liquidity catches a cold. Japan is the largest foreign holder of U.S. debt. If they are forced to sell that debt to save their own currency, U.S. interest rates will explode. Not because the Fed wants them to, but because the market forces them to. Imagine mortgage rates hitting 10% or 12%, not because of U.S. inflation, but because of a currency crisis in Asia. That is the global trigger, the derivatives bomb. Now, let's go deeper into the plumbing. Let's talk about the quadrillion-dollar elephant in the room. Derivatives. Most people don't know what a derivative is. Simply put, it is a bet. It is a contract between two banks that derives its value from something else: an interest rate, a stock price, or a currency exchange rate. These are essentially insurance policies that banks sell to each other. The Bank for International Settlements (BS) estimates the notional value of these contracts is over $700 trillion. Some estimates put it over $1 quadrillion. That is more than all the wealth in the world combined. How is this possible? Leverage, Banks bet on bets on bets. It works perfectly as long as the world is stable. But the world is no longer stable. Here is the nightmare scenario for 2026. Let's say a major European bank, like Deutsche Bank or Societe Generale, gets into trouble because of bad real estate loans in Europe. It happens. But here is the problem. U.S. banks are the counterparty to trillions of dollars of European derivatives. J.P. Morgan, Goldman Sachs, Bank of America, they have sold insurance to Europe. If a European bank fails, the U.S. banks are on the hook for the payout. This is exactly what happened with AIG in 2008. AIG didn't originate bad mortgages. They insured them. And when the mortgages went bad, AIG owed more money than existed. Today, the web is 10 times larger than it was in 2008. This is called counterparty risk. You might think your local bank in Ohio is safe. But your local bank relies on a regional bank, which relies on a national bank, which is trading derivatives with a failing bank in Zurich. It is a daisy chain of debt. When one link breaks, the liquidity freezes instantly globally. And when liquidity freezes, credit stops. No car loans, no small business loans, no mortgages. The value of your assets depends on the availability of credit. If nobody can borrow money, your house is worth what someone can pay in cash. And that is about 50% less than what Zillow says it is worth today. The de-dollarization threat. For the last 80 years, America has had a superpower that no other country has. We can print the global reserve currency. We can run massive deficits, and the world buys our debt. Saudi Arabia sells oil in dollars. China sells goods in dollars. This creates a permanent demand for U.S. dollars and U.S. Treasury bonds. It keeps our interest rates artificially low. It keeps your mortgage cheap. It keeps your imports cheap. But that era is ending right in front of our eyes. The BRICS alliance, Brazil, Russia, India, China, South Africa, and now Iran, Saudi Arabia, and UAE's actively building an alternative system. They are trading oil in yuan. They are settling trade in gold. They are dumping U.S. treasuries. Why does this matter to a homeowner in Kansas? Supply and demand. The U.S. government needs to sell $2 trillion of debt every year just to keep the lights on. If China isn't buying, if Japan isn't buying, if Saudi Arabia isn't buying, who buys? There is only one buyer left, the Federal Reserve. But if the Fed prints money to buy the debt, we get hyperinflation. If the Fed doesn't buy the debt, interest rates have to rise until domestic buyers step in. Market analysts estimate that without foreign buyers, the natural rate on the 10-year Treasury is around 7 to 8%. That translates to mortgage rates of 11 to 12%, permanently. Imagine what happens to U.S. housing prices if 12% mortgage rates become the new normal. Prices would have to crash 40% just to be affordable. This is the de-dollarization discount. As the world rejects the dollar, the standard of living in America drops. We have been exporting our inflation to the world for decades. Now, the world is sending it back. The geopolitical supply shock. Let's move from finance to physics. Real stuff, oil, food, computer chips. The global supply chain is built on the assumption of peace. It assumes that a ship can sail from Taiwan to Los Angeles without being shot at. It assumes that oil can flow through the Strait of Hormuz without interruption. That assumption is dead. We are entering a period of kinetic economics. Wars in Ukraine, the Middle East, and tensions in the South China Sea are not just political tragedies. They are economic circuit breakers. Look at the Red Sea crisis in 2024. A few rebels with drones forced massive container ships to go around Africa, adding weeks to delivery times and spiking costs. Now imagine a blockade of Taiwan. Taiwan produces 90% of the world's advanced semiconductors. If that supply is cut off, the U.S. economy stops. No new cars, no new phones, no data centers. Factories close. Unemployment spikes. But here's the twist. Usually, when unemployment spikes, inflation goes down. In a supply shock, unemployment goes up and inflation goes up. This is called stagflation. It is the Federal Reserve's worst nightmare. They cannot cut interest rates to help the economy because inflation is high due to supply shortages. They cannot raise interest rates to fight inflation because the economy is already crashing. They are paralyzed. And while they are paralyzed, your cost of living skyrockets while your asset values plummet. This is the global trigger of war. It creates a scenario where the tools of the central bank are useless. You cannot print oil. You cannot print computer chips. You cannot print safe passage for cargo ships. The euro-dollar squeeze. There is a secret currency market that is bigger than the U.S. economy. It is called the euro-dollar market. These are U.S. dollars held in banks outside the United States. In London, Singapore, Cayman Islands. Nobody knows exactly how big it is, but estimates range from $13 trillion to $20 trillion. This is the oil that lubricates global trade. When a company in Brazil borrows money to build a factory, they borrow in euro-dollars. But here is the trap. When the U.S. dollar gets stronger, or when U.S. interest rates rise, this system breaks. The borrowers in Brazil, Turkey, and Indonesia suddenly can't pay back their dollar debts. Their local currency is crashing against the dollar. They scramble to buy dollars to pay their debts. This creates a short squeeze on the dollar. The value of the dollar shoots up violently. You might think, great, a strong dollar is good for America. Wrong. A super strong dollar destroys U.S. corporate earnings. Apple, Microsoft, Coca-Cola, they sell to the world. When the dollar spikes, their foreign profits collapse. The U.S. stock market crashes, and, more importantly, the foreign nations are forced to sell their U.S. Treasury bonds to get cash to defend their currency. It goes back to the same loop. Foreign selling greater than rates spike U.S. housing crashes. The euro-dollar system is the invisible noose around the neck of the global economy, and the Fed has no control over it. It is an offshore, unregulated casino. And in 2026, the House is calling in the chips, the Great Repatriation. So, how does this all end? It ends with the Great Repatriation. As the world becomes more dangerous, capital is scared. It is fleeing Europe. It is fleeing China. It is fleeing emerging markets. Paradoxically, in the short term, this money floods into the U.S. Not because the U.S. is healthy, but because it is the cleanest dirty shirt in the laundry. This creates a final blow-off top melt-up in U.S. stocks, confusing everyone. Look, the market is hitting all-time highs. Everything is fine. It is not fine. It is a capital flight panic. But once that money is here, the U.S. government will trap it. Watch for capital controls in 2026. Rules that make it hard to move money out of the country. Rules that force pension funds to buy government debt. The global system is fragmenting into blocks. The West versus the East. The dollar bloc versus the BRICS bloc. Global trade, which has driven prosperity for 40 years, is going into reverse. Deglobalization is inflationary. It is inefficient. It is expensive. And it means the era of cheap goods and cheap mortgages is gone forever. The global safe haven strategy. So, if the threat is global, your defense must be global. You cannot just hide in U.S. cash. Cash is vulnerable to the inflation caused by war and debt. Here is the strategy for the global trigger scenario. First, commodity dominance. In a fractured world, things matter more than promises. Paper money is a promise. Oil, copper, uranium, gold, these are things. War consumes commodities. Rebuilding supply chains consumes commodities. Portfolios heavily weighted in energy and industrial metals historically outperform during geopolitical conflict. You want to own the inputs of the economy, not the consumer of the economy. Second, geographical diversification. This is the hardest for most people, but it is crucial. If you can, have a bank account in a jurisdiction outside the blast zone. Look at Singapore. Look at Switzerland, though less so than before. Look at Dubai. Simply having legal access to funds outside the U.S. banking system is an insurance policy against capital controls. Third, gold is the universal language. When the yen crashes, or the euro breaks, or the dollar debases, central banks turn to gold. It is the only neutral reserve asset. It has no counterparty risk. It cannot be sanctioned if you hold it physically. It cannot be hacked. In a world where trust between nations has collapsed, gold is the only trust left. Fourth, the global mindset. Think global, act local. Your supply chain should be as short as possible. If you rely on food from Chile and medicine from China, you are vulnerable. Support local food systems. Build community resilience. The shorter the distance between you and your essential needs, the safer you are from a global shipping collapse. The eye of the storm. We are currently in the eye of the storm. The first bands of rain hit in 2020 and 2022. Now, things feel strangely calm. The stock market is up. Unemployment is relatively low. But look at the radar. Look at the horizon. The storm is spinning out in the ocean in Japan, in Europe, in the Middle East. It is gathering energy, and it is moving toward us. The crash of 2026 will not be a failure of capitalism. It will be a failure of global central planning. It will be the moment when the artificial stability of the last 40 years finally breaks under the weight of reality. Don't let your home bias blind you. Don't assume that because things look quiet on your street that the world isn't burning. The fuse has been lit globally. The explosion will happen locally. Right in your 401k, right in your home equity. You have been warned. The world is changing. The rules are changing. And the only way to win is to understand the new game before the referee blows the whistle. Subscribe to the channel because in the next video, I am going to deep dive into the specific war portfolio. I will show you exactly which sectors thrive when the missiles start flying. Stay safe, stay alert, and watch the horizon.